Chapter 5, Problem 3. This is listed as exercise 510 in your text. They give us some information about the Roth Service Company. Well, right away, that tells us something. Service company means they're not going to have any inventory. So, they had these transactions for the year. They earned $110,000 of revenue. They collected $89,000 of cash. I can't help it. I'm an accountant. I have two numbers. I have to do something with them. $110,000 revenue. They collected cash of $89,000. My accounts receivable balance has to be $21,000. Not sure I'm going to need it. I think I will, but I'm not sure. But now I have it. Okay, they paid $41,000 of salaries, so that's an expense. And they adjusted the accounts using the following information from an accounts receivable aging schedule. That means they recognize an allowance for doubtful accounts. So, they give us that schedule. Let's take a look at it. Remember our accounts receivable balance, that was what we figured out up here, was $21,000. And you remember how I got that. I took the $110,000 in revenue and sales. I subtracted the $89,000 in cash that we collected. $21,000 has to be left in accounts receivable. Either that or somebody stole it. So, let's take 1% times 21,000. 5% of 21,000. 10% of 21,000. 30% of 21,000. And 50% of 21,000. Because that's what they tell us they estimate. This is called an aging schedule. Many companies do this. You may never have to do one, you may have to read one. So, 1% of the 2,100 is uncollectible, but it's really not the 2,100 because they took this and they laid out all of the amounts and they said, well, of the 2,100, 9,500 of it is current. Of the 21,000, excuse me, 4% of it, or 4,000 of it is 30 days old. Of the 21,000, 2,500 is between 31 and 60 days. Of the 21,000, 2,000 of it is 61 to 90 days. And of the 21,000, 3,000 of it is 50 is over 90 days. This part here is just based on experience. You won't have to do that. You'll hire a fool like me to do that. The mistake you could have done was that you could have taken these numbers to come up with the allowance. You would only do that if they said at the end of the year the total. But here they broke it down month into periods. So we have the bins, and they told us how much is in each bin. And they literally do that by taking the receivables and sorting them, putting them in this pile, this pile, this pile. So, 1% of $9,500, $95. 5% of $4,000, $200. 10% of $2,500, $250. 30% of $2,000, $600, and 50% of $3,000 is $1,500. You add those together, you come up with $2,645. That's what they expect the balance of that $21,000 that they will not collect. By the way, if you add this up, you come up to $21,000. So that's where all the numbers on that sheet came from. So now they ask us, organize the information in accounts using an accounting equation. And we can do that. So, first transaction, they provided $110,000 of services on account. Well, that's revenue. So, $110,000 of services on account. My notes are falling all over. That's what you're hearing in the background. $110,000. So that's accounts receivable. And retained earnings. Remember, this is revenue minus expense equals net income, which goes through my magic funnel to equity. So we have retained earnings, the revenue part of it of $110,000. Okay, the other thing we have to keep in mind is this is the first year of operations. So there's no beginning balance of retained earnings. Then they say that we collected $89,000 from that accounts receivable. So that's over here. $89,000 in cash and $89,000 worth of people owe us less money. Then they tell us we spent $41,000 for salaries. Well, we paid, there's the magic word, paid, cash out, $41,000 for salaries, $41,000, that's an expense. Remember, revenue minus expense, net income. Net income goes to equity in forms of retained earnings. These are the earnings, or would be if I had the right number of zeros. And then the last thing, and this is the one that you could have forgotten, was that they say that we adjust the accounts using the following information. So we adjust for accounts receivable. So we have to take this and recognize this as bad debt expense. So that's what goes into our allowance for doubtful accounts, $2,645, and that's an expense, $2,645, because we're saying that all in all, we expect of that $21,000, $2,645 will not be collected. So let's just total up our columns. Our cash, $48,000. Our accounts receivable, $21,000. Our allowance, $2,645. And remember, the difference between those two is accounts receivable at net. And our net income, when we take our 110 and subtract the 43,645, we come up with 66,355. And at this point, I'm hoping you see how these numbers kind of tie together. They don't just hang out there by themselves. They really do all sort of nest together. Okay, let's do an income statement. And we've done these a billion times before. We're going to do them again. And you're going to do these again and again. And more importantly, in your careers, you're going to be given these and asked to analyze and talk about them and make decisions on them. You guys are going to be managers. You have to be able to look at this stuff and say, so that's what that means. So, service revenue, $110,000. Actually, we can probably go from our equation. It would probably be easier. Our expenses, we have $41,000 and $26.45. So we have salary expense of $41,000 and uncollectible accounts expense, sometimes called bad debt expense, $26.45. So that gives us total operating expenses, because remember, bad debt expense is a regular, normal, ordinary cost of doing business. $43.65 is how much we're subtracting as the total operating expenses, and our net income therefore is $66,355. Now, I want you to think immediately. Net income is $66,355. This is our first year of business. Therefore, our retained earnings balance is $66,355. And indeed, it is. The last thing it asks us to do is determine the net realizable value of the accounts receivable. Well, if you remember right, our accounts receivable had a balance of $21,000, from which we will subtract the allowance, the amount we say we don't think we're going to collect, and that will be accounts receivable at net. So our accounts receivable is $21,000. Our allowance for doubtful accounts, $2,645. And our net realizable value for accounts receivable, $18,355. Not a terribly difficult problem, a little on the long side.